What happens when your startup grows, but you're suddenly blocked from hiring a key executive or pivoting your business? You may have agreed to it months earlier, buried deep in your charter provisions and investor rights. Today, we're unpacking the hidden power behind these clauses that can protect your equity, flexibility, and long-term vision. In this video, we'll cover liquidation preferences, protective provisions, anti-dilution traps, and voting and conversion rules. So let's break it down. Hey everyone, I'm Corey, a startup lawyer helping entrepreneurs decode law, technology, and innovation. This is part 3 of our NVCA Term Sheet Series, a multi-part playlist for founders and investors navigating fundraising with confidence. If you missed part 2 on evaluation and dilution, make sure to check out the playlist below in the description and catch up first. So here's what we'll cover in this video. Key charter terms for NVCA documents, shareholder rights and investor protections, what founders should watch out for, and best practices when negotiating these clauses. What are charter provisions? These are core rules in your certificate of incorporation, typically in Delaware, governing how your startup operates and how investors are protected. The provisions in this document will include references to dividend payments, requirements, liquidation preferences, and conversion rights. So let's look at liquidation preferences. Key decisions. Participating preferred is double dipping on exit. Non-participating, it means pick one, preference or equity share. There are multiple preferences. For example, you could have a 1x liquidation preference, a 2x liquidation preference, etc. And these can really slow down exit proceeds. A simple example, if an investor gives you $100 and they have a 1x liquidation preference, that means in the event of some sort of a sale, they will get that $100 back. If they have a 2x liquidation preference and the same investor gave you $100, it means that they're required to get $200 back. You can add zeros and you can start to see how the implications of this can play out. Let's look at protective provisions. Investors often get veto power over issuing new shares, changing the business model, or selling the company. Now, what's a common problem here? Too many vetoes will cause founders and founding teams to lose momentum. Let's look at anti-dilution terms. This protects investors in down rounds. For example, there's a full ratchet, and this is a total repricing of the equity, and there's weighted average, which is formula-based. Full ratchet sounds fair until you raise again and lose 30% of your equity overnight. Now note, I have another video going more in depth on this topic as well. Let's look at conversion mechanics. Preferred shares usually convert to common equity during key points in the life of a business. And this is included in the charter, and that charter will be on file with the state where that company is incorporated. Typical examples include an IPO, an exit, such as a merger and acquisition, or a majority vote of all the shareholders, typically preferreds, but it could be all shareholders, or there could be some specific predefined trigger. Unclear triggers or poor definitions can cause disputes or delays. The key point here is that the charter is the main document that's on file with the state that will govern the organization of the company, and it will lay out all of the key issues such as board control, structure, liquidation, protective provisions, etc. This will be mirrored in the NVCA term sheet, and this will also show up in the various transaction documents. But the key point about the charter is the charter is filed with the state, and it will typically be a public document. Okay, so let's recap. Charter provisions shape your company's legal DNA. Core areas within the charter are liquidation preferences, which can impact exit payouts, protective provisions, which govern investor control over key decisions. Anti-dilution terms can bite hard in tough rounds, and that could be full ratchet or a broad-based anti-dilution, which is shared by all investors. Also, I mentioned dividends at the beginning of the video. We didn't go too in depth on that, mainly because the dividend concept is going to be something that's going to be outlined in the NVCA term sheet, and it's pretty standard and set. This is part 3 of our NVCA term sheet series. Make sure to watch the full playlist to keep your startup investor ready and protected. Join me on the path to decoding law, technology, and innovation to grow your business. And don't forget to like, share, subscribe, and hit that notification bell. Until next time.